Good afternoon. I am John Imhof, partner at Seward and Kissel, a law firm specializing in maritime and transportation law, among other things. I'm very pleased to introduce a very distinguished panel to speak on this topic, which is private equity in shipping. Quickly, Art Regan, who is with Apollo Investment Consulting, and next to him, Isaiah Toback, who's with Castlelake LP. Then Ty Wallach, who's at Paulson and Co. To his left is Akis Tsirigakis, who's the CEO and chairman of Stellar Acquisition 3, a publicly traded special purpose acquisition company. And at the very end, Egemen Duzgoren, who's with Garrison Investment Group, formerly with CIT. As I read about private equity in shipping, the story seems to be of late that private equity's had its fingers burned in the sector, in the industry, and I haven't seen quite as much investment coming out of private equity, at least not in the pure equity space. There seem to be a number of private equity funds that now have sponsored lenders and finance companies for shipping, but true equity investment in shipping seems to be a little bit down from previous years. And again, as always the story seems to be that private equity has had its fingers burned in the industry. Art, what are your views and what do you see going on in the shipping space at Apollo these days?
Well, I mean, it's no secret that many shipping investments are under their investment mark right now, and that's the way it's trended in a number of the shipping sectors in the last couple of years. So when you say, is private equity interested in shipping still, I mean, absolutely they're interested in shipping, but it is quite hard to go to an investment committee when your existing investment might be underwater. So then you've got to be somewhat defensive. You've got to describe what you think your view is going forward, what strategies you're employing in order to maintain maximum value for the investment, even if it is under your original mark. So a large firm like Apollo, who is investing in every different industry throughout the capital structure, both equity and debt and mezzanines in between, is absolutely interested in a large industry like shipping. Requires a lot of capital. It fits the mandate of the firm perfectly, but there will be periods of time when there's more interest and more motivation to invest, and that's really about the marketplace. So the idea that you can ride this tremendous volatility upward in shipping and then get out, we've seen that not play out in almost every shipping sector. So I would say generally the attitude is probably more conservative, more contracted revenues oriented, so just to try and take the edge off a little bit. So, But Apollo is definitely extremely continuing to be interested in the shipping industry across all the sectors, but probably a little bit more conservatively at the moment.
Isaiah, what do you think of that? I mean, someone once said to me, I'd like to make something back on my initial investment in shipping before I make another one. Is that smart or maybe foolish?
No, I think that's smart. Having said that, though, I think people talk about shipping like it's one industry. The reality is that each segment trades entirely separate from the other, and they all have their momentum trades that people, I think, get caught up in. So I do think it's important, at least when I'm of my committee, to distinguish between those various markets. I don't think that our performance in dry bulk should influence our investment decision in product tankers and vice versa. And I agree with Art that I think that there's a tendency, or at least up until 2 months ago, there was a tendency maybe to start investing with more contracted or at least kind of taking the edge off type trades, to borrow a phrase from Art. But I do think that when people go into their investment committees, this whole burnt hands consideration or burnt fingers consideration, you need to be able to parse that out from whatever you're looking at now.
And how do you see it, Ty?
First of all, I think there are a lot of folks who are a little gun shy because there have been a lot of losses in the sector over the last 5 to 7 years. I think, I joked to some of the panelists before that, we're among the top performers because we've only lost a little money because we haven't had that much exposure in shipping. But I think those conditions create some real opportunities for private equity investors, particularly when you look in certain sectors like dry bulk where you can actually buy ships for a lower valuation than where some of the publicly traded companies are trading out there in the market. Now, there are offsets to that. You probably don't get the leverage that some of the public companies have out there, but I'm not sure if you necessarily want all that leverage. And if you can make solid investments on an unlevered basis, it seems like there should be some pretty good opportunities out there.
And Akis, you come at this from a very different perspective as running a SPAC. What do you see in the market?
Well, it's not very unlike the private equity view. SPAC has some money from investors that are to be invested with certain criteria, which criteria are similar to those of private equity anyways. And you have to be counter-cyclical minded in this industry. And private equity can afford that with a 5 to 7 years horizon. And a SPAC with its time allowance to invest can take that counter-cyclicality into account as well.
Oh, interesting. And Egemen, you've now been at Garrison for more than a year? A little more, right?
Almost a year.
All of a year, that's right. I remember seeing you at the last conference this time last year, and you were just moving.
I think once the PE invests into shipping, they become an active player in the market. It's a cyclical industry. It's not something that you can go in and out over a day or a week. And like each segment goes, it's cyclical in different points in the time horizon. So I think all of the players are closely monitoring the market and selectively looking at investments.
One thing that I also hear in touring the conference circuit, speaking about private equity, ship owners who seem to lay some of the blame for oversupply on private equity, who years ago rushed into different sectors and with new buildings. Does anyone want to respond or take on that challenge?
Sure.
Go ahead, Isaiah.
I think private equity absolutely has a big part to play in exactly what happened and what continues to happen in this market. At the end of the day, I think private equity is supposed to bring two things to the markets that they engage in: discipline and capital. We brought the second. I don't think that we brought the first. I think we continued to not bring the first. The reason being is that the consolidation play that I think a lot of people tried to convince themselves of, I don't think is a reality. And I think that the best way to get in and out of this market is by being measured and being disciplined. And I don't think that we've really approached this market in a way that would be normal or kind of consistent with that theme.
Well, the usual theme for private equity investments, or one of them, there are many, is to move into an industry, help it consolidate, be more efficient, looking closely at management and trying to influence transparency and consolidation. But you're right, we haven't seen very much consolidation. Why do you think that is? I mean, there has been some, obviously, in the container space, but why do you think that there hasn't been more?
I think that the capital intensity required in this market just doesn't exist. You can't have a market that has little access to leverage at this point in the cycle, at least, and actually expect for a real aggregation strategy, a roll-up strategy to really take place unless you have multiple funds come together. And I mean, private equity is pretty well known for not playing very nice together. So I think you need cooperation that people still today really aren't willing to bring.
Does anyone want to add to that? Go ahead, Akis.
There's another reason, yes. You see, consolidation is fine for creating the volume that's necessary to bring the Fidelities of the world into shipping, but doesn't really create better efficiencies. We've seen it time and again. You have a sufficiently large fleet of, 30 vessels, let's say. Even if you go to 70 vessels, the efficiencies that are incremental, marginally, are not really there. I mean, you can have.
Isn't it? Aren't the big shipping companies, the publicly listed ones, the ones that have the easiest access to capital, and it's the smaller ones who are finding themselves a little bit without, or have difficulty accessing the capital. If they got together, would that not give them access to more capital?
Of course they would, and I'm arguing for it, actually. But I was just addressing the efficiency and cost side of things. But of course, volume would bring additional investors and into the space, and we need that.
What do you think are the lessons learned by private equity? You were talking about they brought the capital without the discipline. We're now in another part in some sectors where there are opportunities that are coming up. What do you think private equity had? What do you think they learned? What do you think they still need to learn? Is it the discipline?
I would say a private equity firm, particularly one that manages a fund with a finite life, should never be ordering new build boats. I mean, if it takes roughly 2 years for a boat to be delivered and you have a fund with a 5-year investment period, you're cutting it pretty close, and you're trying to make an assessment of the market 2 years out. And given the volatility we've seen across the different segments of shipping, there is no reason to be buying new boats as opposed to buying one that's just been delivered, or a boat that's been on the water for a few years and still has a amply long life to it. But just given the volatility and the liquidity you're going to want at some time to get out, it doesn't make sense for someone who is managing a fund with a finite life.
And that actually did happen. People bought long on ships.
I want to second that. I totally agree.
and then found they couldn't get rid of them and got stuck with them. So liquidity is also important.
I think there's a lot of funds who are finding themselves with those types of considerations.
Yeah.
I don't think that's just a few. I think that liquidity in general is harder to come by than I think people originally underwrote. And I think that has to do, I think that private equity, first off, when coming into the segments, typically I think doesn't have a great handle as to the fact that these vessels are not homogeneous. I think that they want to believe that they are homogeneous. So I think that people underestimate that fact when they get into it, which impacts liquidity. I also think that private equity doesn't have a great handle of what, at least US private equity and European private equity doesn't have a great handle of what Asia's doing in general. It's such a global segment that I think we don't really get to know the super funds that are getting involved in, Vietnam, Korea, China, Japan, whoever is getting involved. I don't think that U.S. private equity has a great bead into their investment thesis, if you will.
We are seeing more. We are seeing some new entrants in capital providers. There are the alternative finance providers. Some of them are private equity backed. Do you think this is they're lending at slightly higher rates in most cases, and trying to fill up some of the gap that's being left by the traditional shipping banks that have retreated. I'm speaking primarily about the traditional European shipping banks that pulled back. Do you welcome this development? Do you see this as healthy for the industry? Art, what do you think?
Yeah, I think it's very healthy for the industry. And just to cover a little branding here, not every private equity firm ordered new ships. So Apollo has never ordered a commodity ship, a new building. So it isn't unanimous that every private equity firm does that. There are some controls in place, but in terms of the development of alternative financing and what we're going to see, I think, in the next couple of years, just more and more and more of that, because the gap that you're talking about is real. The desert of commercial banks that are interested or can lend in shipping, there's just very, very few right now. So,
Egemen, what do you think?
I think alternative capital could be good for the industry. There's a lack of financing, as we see across the board. However, if it's a smart thing to use that or not could be determined when you can see the upturn on a particular industry and the rates that you're borrowing. It might not be the just good decision at the end of the day.
Anybody else want to add anything?
I think people using alternative financing need to ask themselves the motivation of those parties. It's a little bit different than commercial banks who are in the business of making loans and having those loans outstanding and continuing to generate administrative fees and the likes. So I think that whenever you, as a private equity fund participant, whenever we see alternative financing opportunities, I think you need to ask yourself, does this person want to be, or does this counterparty want to be in the business of just lending to me, as opposed to maybe someday owning my vessel? And so that motivation needs to be taken into account. Having said that, though, I do agree that it is necessary for the capitalization of this market. At the end of the day, I think the pendulum has probably swung too far from the commercial banks. I've recently been part of a commercial bank lending opportunity that kind of demonstrated to me that markets have very much turned from a finance capital perspective in terms of expectations of what you're expected to give. Just negotiating covenants, it is not the same market that it was even a year ago in terms of available capacity. So it's a necessary evil, unfortunately.
What are your views on how the public markets are valuing shipping these days? And I know it varies by sector. Are they using the right methodologies, or are they doing something incorrect? Ty, do you?
Yeah, I mean, I'll say if you look at the public markets, in certain cases, they might appear overvalued when you look at what ships might trade for in the market, and then look at the ships that a company owns, and then you look at where the equity trades. But I think you have to examine the whole balance sheet, and you have to think about what the industry will look like and what that company will look like a couple of years from now. Because again, if the leverage that's already in place, which is in most cases not replicable, may make a big difference in the upside of that equity if you take a positive view on the subsegment over the next few years. There are a lot of folks out there trying to raise private equity capital right now to buy dry bulk. If you look at some of the public guys, as I said earlier, they are trading at valuations that are in some cases meaningfully bit larger than or more expensive than where you could buy boats out there. But if you apply the same model to what those boats will be worth in a few years, and then you layer on the relatively attractive financing that's already in place, you can actually potentially have some higher equity returns in some of the public players. So that may make sense. Having said that, it's a leverage play. Leverage works both ways. If you're wrong, you're in a lot worse shape. So I understand why the public valuations are where they are in certain cases. But it's in many of those cases, it's not necessarily just based on the value of the ships. And because the equity accounts in some of those companies are so low, it may look like it's trading at a big multiple of NAV, but relative to the enterprise value of the business, the premium's not that big at all.
Do you think we'll see more of a shift to valuation by enterprise value? Because that's not been traditionally the way shipping values itself. It's usually been NAV. But do you see that as a potential change?
I don't know if it's a potential change. I think people should look at both. We certainly look at both, and you have to really think about all the potential outcomes and what leverage can be. But if you're just looking at the NAV, you're kind of ignoring the rest of the capital structure, which again is pretty important, as a lot of people have found out.
I see, Akis, you're nodding. So you agree with that?
Yes, of course I agree. I just feel that the model in the public companies is still evolving. I think we don't want to see very high debt in a public company, public shipping company. I think, especially if you combine that with dividends, it's a contradiction in itself, and you don't want to get into covenant territory with you better off utilizing the currency that the public markets provide you to actually do that, and do it to be a lot more conservative on the debt side. Use your currency.
Yes. Yeah. Does anyone want to add to that?
The shipping industry has always had trouble trading around earnings multiples because it just doesn't exist with any consistency over a period of time. During the peaks, you want to use that as a multiple because it benefits you, but when you experience the invariable downturn, it becomes helpless to try and do it. So it's a major factor in the valuations that we haven't been able to take advantage of, really. Most industries have some consistency to earnings, and shipping doesn't. And that makes, I think, a lot of external equity investors a little bit concerned about how they're going to value this thing. So, and they don't move because it's too unpredictable.
You said earlier, Art, that you're looking at deals, you're still interested, but more than that, you're looking at deals constantly. What are you seeing these days, and what are people coming to you with, and how? What makes the difference between an interesting, good deal and a bad one these days?
There's definitely been a result of the lack of bank financing that more deal flow is coming because there's no other option, frankly. So how do you fill that gap? The cost of the deal has to go up for the sponsor. It just does. So, I mean, in history, the risk of the shipping industry with extremely low, high leveraged debt financing and relatively small equity, that's just not there right now. So what happens is the cost of the equity has to go up. It just does. And that favors alternative financing providers like Apollo and others.
Isaiah, you agree with that?
Yeah,
Is that-
yeah, I definitely do. I mean, one of the problems with the overall kind of weighted average cost of capital of the asset itself increasing as financing becomes less available is that I think it continues to put pressure on people who already have investments in shipping on their exit valuations, right? I think that people who want to continue to come back to markets basically have to consider the cash flow dynamics as opposed to the asset value recovery, because I don't think that the asset values can recover as financing dries up. I mean, if cost of capital goes up, the asset value is almost definitionally capped in terms of its recovery. So until you see some greater stability, I just don't see asset values kind of driving return, if you will. In terms of where we're focused, Castlelake remains a value investor, and we're pretty conservative, and we are measured in the markets that we participate in. And so we take a view on certain segments, and we wait for the counter-cyclical trade to come together, because the pendulum seems to swing even more quickly nowadays. So, I don't think that you'll see us kind of getting involved in some of the momentum trades that you're seeing other private equity funds partake in today.
Egemen, do you want to add to that?
I'll agree with the participants. We look at the cyclicality, and I think mispricing in terms of having good discounts on the assets attracts all the private equity investors in certain segments. And I think as the private equity investors get more involved with the ship management and listen their partners and do day-to-day involvement with them, it creates more opportunities in the market.
Akis, Tide, do you want to add anything?
I would just reiterate what the other panelists said. I'd also note that type of market benefits folks who have capital. When there is less of other people's money out there that you can spend, and you have to spend it yourself, you're going to look for those higher returns. But if you have capital and others don't, you're going to be in a better buying position.
We've got a few minutes left. Did any one of you want to add anything to the discussion? Bring up anything?
I'd like to add a positive note on the new buildings outlook and so forth. And I think it's a very, very positive thing that the German KG system, the limited partnership system that existed in Germany and was really supported by the German banks, has disappeared, has collapsed completely. And with it, the German banks.
Yeah, there's some stress there.
And so, yes, PE has been criticized for, or at least part of the PE has been criticized for actually supporting new buildings, which have contributed to the, but it was not PE the primary factor, it was the KG system. They were building speculatively, and fortunately that has stopped. It has stopped, I think, for good. So as long as the demand absorbs the current oversupply, we should be seeing, especially on the dry bulk, better days soon. I mean, that's the common view anyway. I'm not saying anything new, but we are never going to not have ship owners trying to take advantage of low prices, new building prices, and yard capacity unfortunately still exists, and people will take advantage of that. Yeah. But let's hope everybody will be constrained.
That might be some of the discipline that Isaiah was talking about.
Yes.
He's nodding. Anything else you'd like to add? we have lunch after this, and we have a few minutes left if anybody wants to ask some questions. Are there any questions for the panelists? Nope. Well, thank you all very much for serving as panel, and thank you to Nicholas and Castlelake.
Well, thank you very much for a great panel. Thank you, John, for being a great moderator again. Now, those of you who signed up for lunch, lunch is on the 3rd floor. You can go up the stairs or take the elevator. Those of you who did not sign up for lunch, please meet us here at 3 o'clock. We have an amazing afternoon session. So those who signed up for lunch on the 3rd floor, those who did not, please come back at 3 o'clock. Thank you.